Hey everyone, Troy Larkham here from Trade Business Accountants, and I just wanted to put this quick video together because just recently I actually had the opportunity to shoot a short presentation for the AWCI, the Association of Wall and Ceiling Industries, and that video was focused on the impact on profitability from small changes in price, because specifically for plasterers, and this goes for a lot of trades that typically work with builders, they get pushed into a place where they feel like the only option is to reduce their price and sharpen their pencil. But in this video, what I do is actually break down the maths and I break down the numbers of why it's so critical that you understand your numbers and you understand that if you do reduce your prices, what that impact actually looks like on the bottom line of your business. So if you're a contractor, if you're a trade business owner, and you find yourself constantly having to reduce your price and you're constantly sharpening your pencil, then you're going to want to watch this video, because I'm going to break down what that maths looks like. And then I actually break down how these plastering contractors should be approaching their business moving forward to make sure they are profitable and they are working with the right builders. So I put this training up on YouTube for free for everyone to watch, in the hope that you go away, you implement what I'm talking about here, you take on board the advice, and that you start to get better results in your business, that you start to need that specialist accounting, advisory, bookkeeping, and tax solution in your own business. But with that being said, let's dive in and give you some insight into what these numbers look like. Hey everyone, my name is Troy Larkham, client advisor here at Trade Business Accountants. We're a specialist accounting and advisory firm that work exclusively with Australian trade and construction businesses, typically turning between 1 to 10 million a year in revenue. Now, Michelle reached out to me and she wanted me to shoot a quick video for everyone here to give you guys a bit of an insight into the impact of pricing on business and project profitability. And the best way to do that is to actually just jump straight into the numbers. So what I've got here is our price to profit simulator that we use to show our clients how much of an impact that either reducing or increasing prices has on their bottom line net profit. Because at the end of the day, that net profit number is probably a big part of why you're in business today, and probably a big part of why you got into business in the first place. So improving that number should be a big focus of yours at all times. But if you're not across your numbers, you're only one bad, uninformed decision away from completely eroding your entire net profit, which is something that happens a lot in the Australian trade and construction industry. So with that being said, let's dive into the tool. All right, so first things first, what I want to do is run you guys through how pricing impacts the profitability from a project perspective. So here in the first column, what we have is what we've initially proposed to our client, which in this case, we can just imagine it's a builder. So here we've got a project price that we've given to the builder in a quote, for example, that is $50,000. Now, we've assumed that in this example that the cost to deliver this project is going to be $35,000. So that's going to be your labor, your materials, equipment hire, permits, other subcontractors that you might be using, and so on. So what that means is what we're left with is a gross profit of $15,000. So that's your $50,000 minus your $35,000. Now, next, what we need to do is consider your overhead. Now, in this case, because we're looking at this from a project basis, it can be quite difficult to have a specific dollar figure of how much overhead each project is covering. So a simpler way to do this is just to imagine, well, over the year, what percentage of our revenue is going to be used to cover overhead, which is going to translate then to a project to project basis. So in this case, for example, we've got 25% of our revenue is being used to cover overhead. That means 25% of the project sale size, or the revenue produced from that project, is going to be used to cover the overhead costs as well. So what we're left with then, after subtracting that overhead amount from gross profit, is we have $2,500 left over in pre-tax net profit, which is a 5% net profit margin. Now, what I want to show everyone though is what happens when we make some slight price adjustments. Well, first, I want to look at this from a discounting perspective. So let's go really, really conservative here and say, the builder, he's received your quote, he's got some other quotes from some other plasterers, and he wants to, he likes you, he wants to use you, but he wants you to squeeze your price a little bit to get the job over the line. So let's say that you're looking at this, you go, you know what, I can sacrifice 5%. So you reduce your price by 5%. So what you can see here is our project price has gone from $50,000 to $47,500. So just a 5% reduction there. Now, our project costs, they remain the same, because it's going to cost the same in labor, the same in materials, and so on, to actually be able to deliver this project. None of that changes. What happens down here, though, is we also have a $2,500 reduction in gross profit. You can see here, even though it was just a 5% reduction in price, it's actually a 17% reduction in gross profit. Now, our overhead percentage of revenue, that stays relatively the same because it's just a small price decrease. But what we're left with here is now we've gone from $2,500 in net profit to $625. That's a 75% reduction in net profit from just a 5% reduction in your price, which is huge. In fact, down here, you can see you'd actually have to generate an extra $142,000 in sales at this new 1% margin on the project to achieve the same net profit before the price reduction. You'd need to do another $142,000 on top of this $47,000 to make this amount of net profit. Now, let's say we go the other way. Let's say you increase your price by 5%. We can see here it goes completely the other way. So just a 5% increase has now increased your net profit by 75%. So we've gone from $2,500 to $4,375. Based off this new margin, we could actually afford to lose $22,500 off this $52,500 up here in sales at this new 8% margin and still achieve the same net profit. So if we went $52,000 minus $22,000, which comes to $30,000, at this new 8% margin, we would achieve that same amount of net profit. So there you can see from a project level how increasing or decreasing your prices actually affects your net profit and why you want to have a handle on your numbers and you're not just discounting without actually looking at your numbers first. All right, so next I want to look at this from a business perspective now. So we've got our $50,000 again with our $35,000 project cost. Now, to look at this over the year, we're just going to say that on average, this business here delivers 50 projects throughout the year. So when we calculate that out over the year, what we end up with is an annual revenue of $2.5 million, which is your 50 times your $50,000 average project price. We have an annual cost of goods sold of $1.75 million, which is your 50 times $35,000 project cost. That leaves us with a gross profit of $750,000. That's $2.5 million minus your $1.75 million. Coming back to our annual overhead as a percentage of revenue, well, at an annual level, it's going to be very similar to what it is at the project level. So in this case, we've just kept it at 25%. So what that means is 25% of this $2.5 million is going to be used to cover overhead expense. So in this case, that means our annual overhead is $625,000. Now, once we subtract this figure from this figure, what we're left with is our $125,000 in net profit over the year, which again is a 5% profit margin. So looking at those projects we're looking at before, if you did 50 of those, this is what the profit and loss would look like at the end of the year. Now, similar to before, let's say over the year though, you consistently reduced your price by 5%. Now, as you can see here, this is reduced from $125,000 in net profit to $31,000 in net profit, just from a 5% discount. Doesn't seem like much, but it's a huge impact. Again, a 75% reduction in net profit. Now, of course, the argument would be, though, that because you've actually reduced your price, you're getting more jobs through the door. So let's go with that scenario. And let's say you happen to get another 15 projects through the door, which is quite a substantial increase. So let's go 65 there. So here we can see we've got a 30% improvement in the number of projects we deliver. We've actually had a 24% improvement in our annual revenue. So that's gone from 2.5 to a bit over $3 million in annual revenue. Our cost of goods sold have increased as well. Our gross profit is better. It's an 8% increase at now $812,000. We're going to assume that the 25% of overhead as a percentage of revenue remains the same. So that means our annual overhead now has increased to $771,000. Looking here though, even with those extra 15 jobs, we still end up only at $40,000 in net profit. That's still a 68% reduction in net profit. So again, we've had a 30% increase in the number of projects, a 24% increase in revenue, but we've only improved our situation with our net profit by 7%. The reality is this business would actually need to generate an extra $6.4 million in sales at this new adjusted profit margin of 1% to achieve the same net profit as before the price adjustment with the 5% margin at the $125,000 net profit. So let's actually have a look at that. Let's say we increase the number of projects that you deliver to 150. Still, you're not making the same net profit as before the discount. You still need another $2.375 million in sales to get to that point, which is huge. So if we go 200, there we go. That's where we hit the equilibrium. So at this point, you're making the same net profit, but there's an extra 150 projects that need to be delivered in the year. and an extra $7 million, 280% increase in revenue in order to achieve the same amount of net profit. Now, this is a very realistic scenario, especially for contractors like plasterers working with builders on slimmer margins. Because you're working on slimmer margins to begin with, any decrease in your price can actually have a huge impact like this on your net profit. If we go the other way now, though, let's say you increase your price by 5%. But like before, because we've increased our price, we'd expect to have a reduction in the number of projects we deliver. So let's say, from this 5% reduction, we actually lose 20 of the projects that we deliver. Let's go 30. So we've had a 40% reduction in the number of projects we deliver, a 37% reduction in our annual revenue, a 30% reduction in our gross profit. But if we come down here, we've actually still had a 5% increase in our net profit. We're doing 20 less projects throughout the year, achieving nearly 40% less in revenue, 30% less in gross profit, but we're still making more net profit. This is why moving forward, it's going to be so important that before you go and cut your prices, before you go and sharpen your pencil for the builder to get that job over the line, make sure you're looking at the numbers from a project and business perspective to see, well, what does that impact actually mean on my bottom line? Because chances are, if you're working with builders, you're going to be on slim margins to begin with. So any small reduction can actually have a huge impact on that bottom line figure. All right, so I hope that quick run through gave you a much deeper insight as to why it's so important that you understand your numbers and you're looking at your numbers and that you're not just discounting for a builder if they start price pressuring you. So for everyone here today, you can actually download this tool for free where you can put your own numbers in and model out these situations in your own business. Just use the QR code in your workbook and you should be able to download it straight from there. But I'll leave the rest of the presentation to Michelle. All right, so I hope you got a lot of value from that session there, and I hope you can now have that takeaway of understanding why it's so important that you're looking at your numbers. And if you're ever getting price pressured or ever pressured to sharpen your pencil, that you actually look at your numbers first and don't just fold to the builder's demands or any other client who may be price pressuring you. It's super, super critical, especially those who already have tighter margins to begin with. Now, just like in that video, I want to give you guys access to this tool as well. So go to the link in the bio. You can go there. You'll see the tool on our website. You can download it for free right now, and you can actually start modeling out the impact of price changes and those impacts on your profitability in your own business. But if you're looking for more assistance and you're looking for more in-depth help, make sure you reach out. This is an area that we're constantly helping our clients with in making sure that they are developing and building profit-driven businesses, not volume-driven businesses that take away their time and make them no money. We're not here to just get by. We are here to be profitable. We're here to produce a cash cow, and we're here to make money and improve the lifestyle that we're creating for ourselves. Again, if you're looking to fast-track things, if you're looking to take your business to that next level, make sure you reach out. We'd love to help. We're passionate about this side of things. Until the next video, keep getting after it.